Welcome back to Investing Talk Podcast.
Today we are looking at SPDR Gold Shares, ticker GLD. And we have to address the elephant in the room immediately. It is January 30, 2026.
And the chart looks like a rocket ship.
It really does. Gold is trading at record highs, having just, smashed through that massive psychological barrier of $4,600 per ounce. So what here is huge. This isn't just a trade anymore. It is a fundamental, a global shift in how capital is being stored.
As usual, before we start, subscribe, like, and comment to this video to support the show.
Okay.
But I have to pause you right there.
Okay.
Because I'm looking at this chart, and I'm looking at the price tag, 4,600, and every single instinct I have is just screaming, danger.
Vertigo.
Absolute vertigo.
Yeah.
I have to play the skeptic here. You're talking about buying an asset at an all-time high. The line has gone vertical. Is this not the classic definition of it, a top?
Well, on the surface.
It feels like we're chasing the train after it's already left the station.
On the surface, absolutely. It looks terrifying. But if you zoom out, this isn't a retail hype cycle. This isn't like GameStop in 2021.
So it's not a meme stock.
Not a meme stock frenzy where people are buying because they saw a funny post online.
So who is driving the bus if it's not retail?
Central banks. Sovereign nations. This is a structural breakout. The drivers here aren't day traders looking for a quick flip. They're billionaires and governments looking for a bunker.
A bunker.
The floor hasn't just moved. The entire building has been elevated.
Okay, that's a big claim, that the floor has moved. So let's look under the hood at the fundamentals. Convince me the numbers actually back that up.
The scale is frankly staggering. We are looking at assets under management, AUM, that have just surged.
Right.
Depending on which data set you look at for this ramp up, we've seen AUM across the complex move from around, 144 billion, and just skyrocket toward a range reported as high as 472 billion.
That is a wall of money. That is a massive amount of capital flooding into the sector.
Yeah, it is. And the velocity is what matters. 2025 saw record inflows. And JP Morgan, they're expecting another 250 tons of ETF inflows specifically for 2026.
That is a lot of metal. But for the listener who might be new to this ticker, we need to clarify what GLD actually is.
Right.
Because you can buy gold in a lot of ways, a mining stock, a futures contract. But GLD is physically backed. This is bullion, sitting in vaults in London. Why does that distinction matter so much right now?
That is the critical question. It all comes down to counterparty risk.
Can you break that down? What does counterparty risk actually look like for an investor?
Okay, so imagine you lend your neighbor $100. You have an asset, the debt he owes you, but you also have the risk that he, moves away or just decides not to pay you back. That's counterparty risk. You're relying on someone else to fulfill a promise.
So in the market context,
when you buy a futures-based fund, you are relying on a complex chain of paper contracts. You have roll costs and you have the risk of the financial plumbing just clogging up.
Whereas with GLD,
if you own GLD, you own a claim on physical bars, sitting in a high-security vault. In a world where people are worried about banks failing, you don't want a paper promise.
you want the rock.
You want the rock. That physical backing is the premium feature. It removes the neighbor from the equation entirely.
Speaking of premiums, let's talk about the cost. I'm looking at the expense ratio here. GLD charges 0.40%, but State Street, the same issuer, has the mini version, GLDM.
Right, GLDM.
Which is only 0.10%. So if I'm a retail investor, why on earth would I pay 4 times the fee for the exact same gold? Am I just being ripped off?
Well, if you are a buy and hold retail investor with a smaller account, yeah, maybe a little. GLDM's probably better for you.
Okay.
But GLD has something the cheaper version doesn't, the liquidity premium.
Meaning it's easier to sell.
It means you can move mountains without causing an earthquake. We are talking about $9 billion in trading volume per day.
$9 billion, that's massive.
That is the moat. Think of it like a doorway. GLDM has a standard size door. Fine if you want to walk through with $10,000.
Sure.
But if you're a massive hedge fund, say Citadel, and you need to park $1 billion in 10 minutes, you can't fit through that small door.
You break the door frame.
Exactly. You'd move the price against yourself. That's slippage. You paid the 0.40% fee specifically for the privilege of a massive hangar door where you can enter and exit instantly.
So it's the big boy table fee.
It is the price of admission for the whales. And speaking of whales, this is where we see the billionaire signal.
I saw this in the notes. This isn't just random accumulation, is it?
No, it's cluster buying. We have Ken Griffin at Citadel, Israel Englander, Paul Tudor Jones, they're all piling in. And Ken Griffin, he's loading up on call options.
Which is aggressive. I mean, Griffin
Yeah.
usually plays both sides, hedging his bets. If he's buying calls, he's not hedging. He's betting on momentum.
He's betting on a breakout. This isn't a safety trade for them anymore. It's a conviction bet. And they are being supported by the biggest whales of all the central banks.
This is the central bank put people talk about.
Yes. They're buying roughly 585 tons per quarter.
But are they price sensitive? If gold hits 5,000, do they stop?
And that's the key. They're price insensitive. They aren't trying to time the dip. They're de-dollarizing their reserves.
Ah.
That provides a fundamental floor to the price that just didn't exist in previous cycles. They are buying for strategic safety, not for profit.
Okay, the fund is huge. Billionaires are in. Central banks are providing the floor. But let's pivot to the charts. What is the price action telling us? Because up is a direction, not a strategy.
The chart is describing a blue sky breakout. When you clear all-time highs, there is no overhead resistance.
Explain that concept, overhead resistance, for the listener who doesn't stare at candles all day.
Sure. Imagine you bought a stock at $4,000 3 years ago, then it crashed. You're sitting there, miserable, just praying it gets back to 4,000 so you can sell and break even.
The bag holder.
Exactly. That creates selling pressure. But when you are at an all-time high like now, there are no bag holders. Everyone is in profit.
So no one's desperate to sell at break even.
There are no clouds overhead. It's blue sky. And the underlying gold price is at 48.30 with the ETF tracking it perfectly. It's a robust, high momentum trend.
Let's talk levels, though. If I want to get in, I hate buying the absolute peak. We recently closed around 496 for the ETF. If we get a pullback, where's the floor? Where do we buy the dip?
You want to look at where the volume accumulated on the way up. We have major support at 388.88 and another level at 372.
Wait, 388. That is a massive drop from 496. That's not a dip. That's a crash.
It would be a significant correction, yes. But those are the concrete floors. That's where the institutional buy orders are likely sitting. However, if you look closer at the recent action, look at the pivot bottom from November 4th, 2025.
I see that.
That launched a 12% rally, straight up. The structure is higher highs and higher lows. Until that structure breaks, the trend is your friend.
One thing I noticed is the volatility. For an asset hitting record highs, it doesn't look like a jagged crypto chart. It looks smooth.
That's the beauty of it. The daily movement range is about $2.80. It's a steady climb. It's not gapping up and down 10% a day.
Controlled.
A controlled high volume advance. And again, looking at that institutional volume, we're seeing unusually high call option activity.
Meaning they're betting on it going faster.
Meaning they aren't just holding shares for safety, they're leveraging up for an accelerated move to the upside.
Okay, the charts look strong, but what is the street saying? Let's check the sentiment. Because sometimes the crowd gets too bullish right before the fall.
The data here is fascinating. We pulled the sentiment data from Alpha Vantage. 7 out of the 8 most recent major articles are bullish. The weighted sentiment score is solidly positive.
That's pretty consensus. Usually, when everyone agrees, I get worried. What's the narrative driving that mood?
It's more specific. There are 2 main drivers. First, the rate cuts. The consensus expectation is that the Fed cuts rates in 2026.
Right, and typically, lower rates mean a weaker dollar, which boosts gold.
Exactly. But the second narrative is more immediate and, frankly, more dramatic. There have been headlines about a Powell probe, a probe into the Fed chair.
I saw those. That creates massive policy uncertainty.
And if there's one thing gold loves more than inflation, it is uncertainty at the top of the Fed. Gold is basically the anti-dollar.
So when people lose faith in the people managing the dollar,
They run to the asset that has no manager. It is rocket fuel for the price.
markets hate uncertainty, but gold loves it. So what are the analysts putting as price targets? Are they chasing the price or leading it?
They are getting aggressive. JP Morgan and UBS are both targeting $5,000 an ounce by late 2026. Deutsche Bank is even more bullish. They're talking about a potential for 6,000.
6,000. That's another 20–30% from here. That's a huge move for a commodity.
It is. And then you have Morgan Stanley, who recently raised their target to 4,400.
Wait, 4,400? But we're already past 4,600.
Exactly. That tells you everything. They are behind the curve. That implies they are going to have to upgrade again just to catch up to reality.
Which creates a cycle of positive headlines.
A scramble to not look foolish.
Is there anyone raining on this parade? Did we find any bears?
We found one. An Invez article from January 1st. They flagged GLD as overbought.
Well, looking at the RSI, they aren't wrong.
They aren't. But even that bearish article admitted the long-term uptrend was solid. It was more of a tactical warning, not a sell everything call.
Okay, well, it can't all be sunshine. We need to execute a deep dive into the risks. What kills this rally? Because when everyone is on one side of the boat, even Ken Griffin, I get nervous the boat is going to tip over.
You should be. The first risk is exactly what you just mentioned. Technical overextension, the RSI, the relative strength index is hot. We are at all-time highs. There is a very real risk of profit taking.
If everyone who bought in 2025 decides to cash out their gains to buy a beach house, we could see a flush.
Exactly. A pullback to the 390s, that support level we discussed, is entirely possible. It wouldn't break the thesis, but it would hurt if you bought the absolute top.
What about the Fed? We're banking on these rate cuts. What if they don't happen?
That is risk number 2. The U.S. economy has been remarkably resilient. If the data stays hot and the Fed decides they can't cut, the dollar is going to rip higher.
And since gold is inversely correlated to the dollar.
It would be a major headwind. If the dollar strengthens significantly, gold usually sells off. Now, that correlation has been breaking down a bit, but it's still a major risk.
I want to bring up risk number 3, which I think is under-discussed. Demand destruction. At $4,600 an ounce, gold is insanely expensive.
The jewelry market.
Exactly. I'm thinking about the jewelry market. That's 40% of global consumption. If I'm in India or China, buying gold jewelry just got impossible. Can investors alone support the price if that market collapses?
That is a very valid concern. Retail jewelry demand usually falls off a cliff at these levels. The average consumer gets priced out. But here is the counter-argument the bulls are making. The central banks.
Right.
As I mentioned, they are price insensitive.
They aren't shopping for bracelets?
No, they are buying for strategic reserves. They are de-dollarizing. They don't care if it's 4,500 or 4,600. They need the ounces to sanction-proof their economies. That institutional flow offsets the loss of the retail jewelry buyer.
So the thesis is that the strategic buyer is bigger than the vanity buyer. The bride in Mumbai is being replaced by the central banker in Warsaw.
Precisely. And the central banker has significantly deeper pockets.
We've seen the flows and the risks. It's time for the verdict. Put a number on it.
I am giving SPDR Gold Shares a bullish score of 8.5 out of 10.
8.5. That is high confidence, especially for an asset at all-time highs. Walk me through the summary.
The macro backdrop is nearly perfect. You have rate cuts on the horizon plus geopolitical instability. That's the classic gold recipe. Then you have the flows, Citadel, Paul Tudor Jones, confirming the smart money is positioning for upside. And finally, the technicals. This is a breakout, not a top.
So how do we trade it?
The time frame here is 6 to 12 months. The target is $5,000 to $5,200 per ounce. For GLD specifically, that implies a price well over $500
Strategy.
by the breakout. But, and this is crucial, keep a stop loss around 395.17.
395.17. Specific.
That manages the overbought risk. If it falls below that, the technical structure is damaged. But until then, you ride the momentum.
That's the verdict on SPDR Gold Shares. If you want us to cover your portfolio, drop the ticker in the comments. Don't forget to subscribe. We'll see you in the next one.